Today is first notice day for the March silver contract, and COMEX registered silver just hit 86,130,399 ounces, the lowest reading in years, and it just broke below the 90 million ounce floor for the first time. That number isn't a warning, that number is the trigger. While COMEX is pricing silver at $89.97, Shanghai is paying $122 to $125 per ounce for the same metal right now, today, not 6 months from now, right now. That $32 gap isn't noise. It isn't a rounding error. It is the market telling you in plain language that the East and the West are no longer pricing the same asset. One side has the metal. One side has paper claims on metal that may not exist in sufficient quantities to honor them. I'm going to show you exactly why 86 million ounces against 230 million ounces of March open interest creates a 2.67 to 1 claims ratio that the exchange cannot mathematically resolve, why Shanghai's $32 premium is a directional alarm, not a trading opportunity, why the biggest institutional smart money move in the SLV in years just happened this quarter, and what the three scenarios are from here and what each one means for your position. Stay with me. Every number I'm about to show you is sourced and verified. Looking at the numbers, roughly 75% of you watching aren't subscribed. Given what today's date is, first notice day, the exact moment the paper to physical tension goes from theoretical to legally binding, if there's ever a day to be subscribed to this channel, it's today. The next 72 hours will either validate everything this community has been tracking or give us new data to work with. You want to be here for that. Hit subscribe and drop COMEX OG in the comments right now. That's how I know this is landing. If it's not for you, no hard feelings. Now let me show you the inventory forensics first, because this is where the story starts. According to the CME Daily Warehouse Report, official data, not my opinion, COMEX registered silver, the only silver legally warranted for futures delivery, stands at 86,130,399.161 ounces as of the February 25th activity date. Total COMEX silver, registered plus eligible combined, is 360,638,935 ounces. That sounds like a lot until you know that as recently as October 2025, 5 months ago, that combined figure was 532 million ounces. The system has shed 171 million ounces in 5 months. That is a 31% collapse in total inventory in less than half a year. That's not drain, that's hemorrhage. Here's what makes this different from every other low inventory story we've covered. It's not just the total, it's where the metal is going. JP Morgan saw a withdrawal of 24,904 ounces in the last 72-hour reporting cycle. HSBC saw 623,546 ounces leave their eligible pile. Manfra, Tordella, and Brooks, 619,157 ounces, gone. And at Brinks, 217,756 ounces were reclassified from registered to eligible, meaning they were removed from the legally deliverable pool without physically leaving the building. The owners of that silver are locking it up. They are pulling it out of the exchange's reach for settlement purposes. When institutions stop making their silver available to the exchange, that is not a neutral decision. That is a signal. The metal is moving, and it is moving east. Let me connect this to the paper-to-physical ratio, because this is the number that defines today, 230 million ounces. That is the approximate open interest in the March 2026 contract alone, per mainstream market data sources. Divide that by 86,130,399 ounces of registered silver, and you get 2.67 claims for every single ounce available for delivery. 2.5 contracts for every bar. For the March contract month alone, some market watchers, drawing on alternative analytical sources, place the total COMEX open interest across all contract months at 429 million ounces, which they claim against what was approximately 103 million registered ounces in early February, yielding a 4.16 to 1 claims ratio. I cannot independently verify the 429 million figure with a single official source, so I will not state it as fact. What I can tell you is this. The verified 2.67 ratio for March alone is already catastrophic on its own terms. You do not need the higher unverified number to understand the problem. The verified number is the problem. Historically, the COMEX has operated on the assumption that only 3 to 5% of contract holders would ever demand physical delivery. That assumption has been shattered. Data from this delivery cycle indicates that delivery demand has surged dramatically, transforming the exchange from a hedging mechanism into what is effectively a physical procurement platform. Traders are no longer waiting for standard delivery windows. They are backward rolling contracts from March into January and February to secure physical bars immediately. According to mainstream analytical reporting, JP Morgan alone issued delivery notices on 99% of 8.1 million ounces in a single week in January. The largest players are racing to the front of the line before the registered pool is gone. Here's where it gets serious. If the exchange cannot fulfill delivery obligations on today's first notice day, it has the legal authority to declare force majeure and settle contracts in cash. That would protect the exchange from technical default. But it would destroy the paper pricing system's credibility in a single announcement. The paper price would become irrelevant. Physical silver would trade at whatever price buyers and sellers agree to. And the market is already showing us where that price is: Shanghai. Now let me show you the Shanghai data, because this is the clearest signal in the entire picture. According to the Shanghai Gold Exchange Daily Report, official source, the SGE AGI T plus D contract is trading at approximately 21,600 yuan per kilogram as of February 26, 2026. Convert that to US dollars, adjust for troy ounces, and you are looking at a price between $97 and $105 spot. The SHFE silver futures contract, per mainstream market reporting, is at approximately 28,346 yuan per kilogram, the equivalent of $122.36 per ounce in USD terms. Against COMEX spot of $89.97, that is a $32.39 premium. Against the LBMA midday fix of $111, the SHFE is still running $11 above London. That premium is not friction. That premium is a vacuum. China controls approximately 70% of global refined silver output, according to market reports. And on January 1st, 2026, China officially added silver to its national export control list. That is not a rumor. That is a verified geopolitical fact. China is restricting outward flow of silver while simultaneously paying premiums to bring more in from whatever sources remain available. SGE silver withdrawals in January 2026 hit 321.7 metric tons, a 287% year-over-year increase, and more than 3 times the 8-year average of 96.56 metric tons. The East is not accumulating silver. The East is emergency hoarding silver. Now here's what nobody's talking about in the mainstream coverage. London is not the backstop everyone assumes it is. LBMA-approved vaults hold approximately 891 million ounces as of end of January 2026. That sounds comfortable until you understand that the estimated free float, silver not already committed to ETFs and other obligations, is somewhere between 200 million and 300 million ounces. And London banks trade volumes exceeding 200 million ounces per day. That means the entire free float of available London silver turns over every single day. There is zero margin for error. One bad settlement cycle, one unexpected delivery demand spike, and the clearing system seizes. 785,000 ounces are leaving COMEX vaults every day. The free float in London covers maybe 1 day of trading volume, and Shanghai is paying $32 over Western spot. Do the math. Here's what makes this different from any previous silver squeeze narrative. The institutional money is moving, and it is moving in a very specific direction. According to Quiver Quant institutional ownership data, a mainstream verified source, Jane Street Group increased its SLV position by 20,631,344 shares in the most recent reporting quarter. That is an increase of over 50,000%. Jane Street is not a retail speculator. Jane Street is one of the most sophisticated market-making firms on the planet. They do not make a 50,000% position increase in a silver ETF because they think silver is interesting. They make that move because they have a structural view on liquidity and volatility that almost nobody else can see from the outside. Simultaneously, Morgan Stanley trimmed its SLV position by 3,768,300 shares, down 17%. Bank of America also cut exposure. Traditional bank money is rotating out. Smart market making money is rotating in. That is a regime change in who owns the paper silver infrastructure, and it signals positioning for extreme volatility or a major liquidity event. Let me connect this to the corporate side, because this is the move that confirms the thesis. Samsung recently secured an exclusive 2-year offtake agreement for the full production output of a Mexican silver mine. Not a futures contract, not an ETF share, a direct physical off-exchange agreement bypassing COMEX and LBMA entirely. When a company the size of Samsung decides it can no longer trust the exchange system to supply its industrial silver needs, that is not a hedge. That is a vote of no confidence in the paper system. And India. Indian silver imports in January 2026 surged 127% year over year, per the Indian Express. Indian Finance Minister Nirmala Sitharaman explicitly attributed the price surge to, quote, aggressive buying by central banks worldwide. That is an official government acknowledgement, not alternative media, that sovereign institutions are driving this market. Now let me show you the macro backdrop, because this does not exist in a vacuum. On February 20th, 2026, the U.S. Supreme Court issued a 6-3 ruling in Learning Resources Inc. versus Trump, striking down the administration's use of the International Emergency Economic Powers Act to impose broad trade tariffs. Chief Justice Roberts wrote that the executive branch cannot use national emergency declarations to seize the taxing powers of Congress. Within hours of that ruling, President Trump invoked Section 122 of the Trade Act of 1974 to impose a new 10% global import tariff on a different legal foundation. The policy environment went from tariffs struck down to new tariff authority invoked in the span of a single business day. Businesses making capital allocation decisions in that environment have one rational response: hard assets. Simultaneously, the BRICS alliance is making its most significant push toward dollar independence in history. The Reserve Bank of India has proposed linking BRICS member central bank digital currencies through the mBridge platform, which already involves China, Hong Kong, Saudi Arabia, Thailand, and the UAE, and has processed over $55 billion in transactions, 95% in digital yuan. Every dollar of trade that moves through mBridge is a dollar of trade that no longer needs the SWIFT system. That infrastructure, combined with the National Bank of Poland targeting 700 tons of gold, surpassing the European Central Bank, tells you that Western allies themselves are building reserve portfolios that prioritize tangible assets over dollar exposure. Gold and silver are not a trade in this environment. They are sovereign insurance that changes the demand equation permanently. Now here's what the alternative analysts are saying, and I want to be clear about how I'm framing this, because compliance matters on this channel. Some alternative market analysts claim the COMEX is already in a state of de facto default. They argue the reason for the persistent $10 plus Shanghai premium is that China knows there is no free float silver remaining in the West that isn't already encumbered by multiple paper claims. Some of these analysts view today, first notice day, February 27th, 2026, as the event horizon where the paper pricing system finally fractures. They also claim that the January 30th crash, where silver fell 31 to 35% in a single day from $121 down to the $64 to $70 range following the Kevin Warsh Fed chair nomination, was a deliberate operation by major bullion banks to shake out retail stop losses and allow institutional players to stand for delivery at distressed prices. I cannot verify those claims. What I can verify is this: 3.3 million ounces were withdrawn from COMEX vaults on the single day of the January 30th crash, per analytical reporting. Whether the crash was engineered or organic, somebody used that price action to pull physical metal out of the exchange at the lowest prices seen in months. That is a documented fact, not a theory. The CME itself increased silver margin requirements from 11% to 15% at the height of the volatility. That margin hike acted as an automatic liquidation mechanism for leveraged futures traders, which accelerated the sell-off. That is confirmed. Draw your own conclusions about intent, but document the behavior. Here are the three scenarios from here. I will give you exact probabilities, and I will base them only on the verified data. Scenario 1, bullish. The March delivery demand overwhelms the registered pool, the exchange cannot fully deliver, and the market begins pricing physical silver against the Shanghai benchmark rather than the COMEX. In this scenario, physical silver moves toward the $111 to $125 range, tracking toward SGE and SHFE levels. This is the scenario where the paper price decouples. Probability, 35%. Not because it is unlikely structurally, but because the exchange has tools, EFP mechanisms, cash incentives to roll contracts and emergency rule changes that can delay the mathematical reckoning in the short term. Scenario 2, neutral consolidation. The exchange manages the delivery cycle through a combination of contract rolls, emergency silver transfers from eligible to registered, and cash premiums paid to contract holders willing to defer physical delivery. Price remains in the $85 to $100 range. The structural deficit persists, but does not force an immediate pricing reset. Probability, 45%. This is the most likely near-term path because exchanges are extraordinarily motivated to avoid headline-generating failures. Scenario 3, bearish, additional margin hikes, dollar strengthening from Warsh-related hawkish Fed expectations, and forced speculator liquidation push COMEX silver back toward the $70 to $80 range. This would be a paper price event, not a physical one, but it would shake out retail holders and provide another window for institutional accumulation. Probability, 20%. Now, let me address each group watching this specifically. If you are a physical silver holder, do nothing. The fundamentals have not changed. If anything, the data today strengthens your position. The registered inventory is at a multi-year low. Shanghai is paying a massive premium over your cost basis. You own the asset that the world's most sophisticated institutions are racing to acquire. Sit tight. This is not financial advice. Use your own brain. If you are trading futures, today is first notice day. If you are long March contracts and did not intend to take delivery, you should have already rolled. If you are short, you need to understand that the registered pool, sitting at 86 million ounces against 230 million ounces of open interest, is not a comfortable margin of safety on the short side. Monitor the daily inventory reports. Monitor SGE withdrawal data. The intraday situation today is the data. This is not financial advice. Use your own brain. If you hold SLV or PSLV, watch the Jane Street position closely. When the most sophisticated market makers in the world accumulate over 20 million new shares of a silver ETF in a single quarter, they are either hedging a massive short book or positioning for a directional move of historic magnitude. The PSLV redemption mechanism, which allows holders to take physical delivery, is a structural advantage over SLV in a true physical squeeze. Know the difference between what you own. This is not financial advice. Use your own brain. If you are watching from the sidelines, you now have the numbers. 86 million ounces registered, 230 million ounces of March open interest, 785,000 ounces draining per day, a $32 premium in Shanghai, 321.7 metric tons of SGE withdrawals in January alone. You have the data. Make your own decision. This is not financial advice. Use your own brain. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research, always. The paper market is being stress tested against physical reality today. Not in 6 months, not in a future delivery cycle. Today, the numbers don't lie, the vaults are draining, Shanghai is paying, and the Western market has no explanation that adds up. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.